Okay, who is reading for question 4? Who is reading for us? Kathy, read for us question 4. Kathy.
Okay. So the Lynx Limited owns a factory at a cost of $1 million as at January 1, 2017. The factory is depreciated at the rate of 12%. As at June 30th, 2018, the entity completed an extension of the factory at a cost of $267,500. The extension increased the production capacity of the factory and extended the useful life by 2.5 years. Required: A. Calculate the carrying amount of the factory as at 31st December 2018. B. Prepare the statement of profit and loss extract for the year ended December 31st, 2018.
All right. So they are saying that the Lynx Limited owns a factory at a cost of 1 million as at January 1, 2017. The factory is depreciated at a rate of 25.
I don't want to know what about this. So we could mean here. Therefore, also Bampana.
As at June 30, 2018, the entity completed an extension of the factory at a cost of 267,500. The extension increased the production capacity of the factory and extended the useful life by 2.5 years. So the extension is a subsequent expenditure incurred on the factory, isn't it? So the question now is, should that 267,500 be capitalized as part of the cost of the asset? If yes, why? If no, why? Last time we said that if the subsequent expenditure has increased the production capacity of the asset or has also increased the useful life of the asset, that particular subsequent expenditure must be capitalized. But when did we buy the factory? When did we buy the factory?
January 1, 2017.
When was the extension done?
June 30th, 2018.
How many years after that?
1.5.
So as of June 30th,
18 months.
2018, we have to know the value of the factory as at that date. So we have to know the value of the factory as at that date. We are depreciating the asset at what? 12.5%, isn't it?
Yes, please.
On yearly basis, how many years is that?
Twelve and a half years.
It will be what?
12.5.
You said how many years?
12.5 years.
You are not serious. 12.5 years.
That will be 8.
That will be what?
I think 8 years.
Yes, it's 8 years. What you do
8
is that
years.
you divide the depreciation rate by 100%. Okay, Kathy, do it. What are you getting?
Please repeat the question.
I'm saying that on yearly basis.
Mm-hmm.
On yearly basis.
Yes, please.
What will be the useful life of the factory?
Okay.
So what we normally do is that for you to find this one, we divide the 100% by the percentage rate that they are using to depreciate the asset. Do 100 over 12.5 and see.
It's 8.
is 8 years, isn't it?
Yes.
All right.
Yes.
So, okay. So what we do is that, first of all, let's find the date of acquisition. What is the date of acquisition?
Date of acquisition is 1st January 2017.
So January 1, 2017. What is the date of extension?
30th June 2018.
Okay. 30th June 2018. Okay. So what we have to do is that we have to know the value of the asset at the date of what? Extension, before we can add the extension value to it. So what do we have to do to get a value of the asset as the date of extension? We bought the asset on what? January 1, 2017. So we have used the asset for 1.5 years before doing the extension, isn't it?
Yes, please.
So what we have to do is that for us to know the value of the asset is that carrying value. You have to know the carrying value of the asset as a date of extension, which is the same as the cost minus accumulated depreciation up to the day of what? The extension. Accumulated depreciation up to the day of the extension. Up to the day of the extension. So how do we find our depreciation? How do we find our depreciation? The depreciation is a cost over the useful life, isn't it?
Yes, please.
So that would be 1 million divided by what? 8.5. What is the figure? $1 million divided by 8.5 is what?
107.
Yeah, I thought
Please,
it's
what's
8. How
from the 0.5?
8.5?
One
It's 8 exactly. It's not
It's
0.5.
is only 8. Okay, sorry.
Yes.
So that will give us how much? That is how much?
125,000.
100 and what?
25,000.
Okay. So that will give us 125,000. That is yearly depreciation, isn't it?
Yes.
But how many years did we use the assets?
8 years.
No. So we bought the assets on January 1, 2017. We did the extension on 30th June. So how many years after the acquisition that we did the extension?
1.5. So 18 months.
So that would be 18 months, isn't it? So we
Yes,
have to find
please.
the depreciation for the 1.5 years. We have to find it. We are looking for the carrying value. We have to find the depreciation for 1.5 years. If 1 year is 125,000, half a year will be how much?
62,500.
62,500, isn't it?
Mm-hmm.
So it means
Yes.
that 1.5 years will be 125,000 plus 62,500. Am I correct?
Yes, please.
So the total accumulated depreciation will be what?
187,500.
187,500. Okay. But what was the original value of the assets?
$1 million.
1 million. So out of the 1 million, how much did we use?
Out of 1 million, we have used 18. Okay,
So the carrying value as at the date of the extension will be how much now?
812500.
812500,
2500.
isn't it? Okay, that is the carrying value,
Yes.
but we did an extension on the building, which cost how much?
So 267,500.
Okay, so the total value of the asset as at 30th June 2018 will be how much now? Total value will be how much now? It will be the carrying value as at that date plus what? What will be the total value as at 30th June 2018? The carrying value is 81,700, but we did an extension which has increased the production capacity of the factory and also extended the useful life by 2.5 years. It means that the extension cost must be capitalized. So what will be the total value of the asset as at that date?
108.
How did you get a 108?
I added the 267,500 to
267,500.
812500.
Okay. Okay. So we know that the extension cost will be capitalized, isn't it? But the extension cost, don't go and add it to the initial value of the asset. No, you bought the asset on 1st January 2017, but you did the extension on 30th June 2018. It means that you have used the asset for 1.5 years before doing the extension. So you have to add the extension cost to the value of the asset as at the date of the extension. That is why you have to find the depreciation for 1.5 years and take it from your initial cost of the assets. That's why we have the 812,500. That is the carrying value as at the date of the extension. So the total value of the assets now will be 812,500 plus 267,500. That will give us how much?
$108,000,
108,000, isn't it?
no, 11 with 10.
Okay, 1,800,000, isn't it? All right. Okay. Okay, let me also show you another way of getting the carrying amount. Getting the carrying amount. What is the depreciation for each year?
125,000.
So we use the asset for how many years?
18 months.
We use it for 1.5 years, isn't it?
Yes, please.
But what is the total useful life of the assets?
8 years.
So if we use 1.5 years, it means that we are going to have 6.5 years remaining, isn't it?
Yes, please.
So you multiply the 6.5 by the annual depreciation. What are you getting? What are you getting? Sorry.
The same value.
Okay, so you can do it anyhow. If you can take the annual depreciation, multiply by the remaining useful life of the asset, because the depreciation will be spread over the years. Okay, so what is the first question? Calculate the carrying amount as at the date. Calculate the carrying amount of the factory as at what? 30 December 2018. Okay, so this is the value of the asset as at what? 30th June. 30th June what? June 30th, June 30, 2018. This is the carrying amount. But they're asking us to find the carrying amount as at the date of what? December, isn't it? That is how many months? From June to that time is how many months? From June to
6 months.
6 months.
is 6 months. So it means that we are going to use the asset for additional 6 months, isn't it? All right.
Yes, please.
But what is now the total value of the asset? We have 8 years first, plus now the extension, which is 2.5, isn't it? What was the initial useful life of the asset? 8 years, isn't it? the extension has increased the useful life by how many years?
3.5.
So in total, what will be the total useful life of the assets?
9.
In total, what will be the total useful life of the asset? 8 plus 2.5.
10.5.
But out of this 10.5, how many years do we use?
1.5.
So the remaining useful life will be what?
9.
9. So it means that then this current amount, which is the 1,800,000, will now be depreciated using 9 years, which is the remaining useful life of the asset. So we have 1,800,000 divided by what? Divided by 9 years, isn't it? But from June to December 31, how many years is that?
6 months.
So we
0.5.
multiply all the answer by 0.5. All right. What are we getting? How much are we getting?
60,000.
60,000. So it means that from June to December, we use 60,000 of the assets, isn't it? So what will be the carrying value as at December 31? What will be the carrying value now? What will be the-
102.
It will be the 1,800,000 minus what? 60,000, isn't it?
Yes.
Okay. So carrying value will now be 1,020,000, isn't it? All right. 1,020,000. That is the new carrying value now, as at the date of, as at December 31. So December 31 is this. All right. What is the next question?
Extract of P&L and balance sheet.
Okay. So P&L, what item will go to P&L?
Depreciation.
Depreciation.
So profits or loss extract. Don't go and say profit and loss. You can't make profit at the same time loss. So it's profit or loss. All right. So let's come here. Okay. The depreciation, what will happen? How much are we taking out of depreciation now? How much will be the depreciation?
It will be the total, the 187,500 plus the 60,000.
They say prepare a statement of profit or loss extract for the year ended that December 31, 2018. So the first one, which is 125,000, is for 2017, which is not part of 2018. Are you okay?
Okay.
So what we do right now is that we add the depreciation for all the 6 months, the first 6 months before the extension and the 6 months after the extension. So the six months before the extension was 62,500. Then we add the depreciation after extension to it, which is 60,000. What will be the total?
1,2,500.
1, 2,
2.
1, 2 to 500.
Yes.
Okay. And depreciation is an expense, so you can put it in a bracket. All right. So this basically is what they're asking us to find. Don't go the extension. When was the extension done? You have to ask yourself, what is the value of the asset as at the day that the extension is done? That is the carrying amount. So find the carrying amount. Find the depreciation for the number of years that you have used the asset before the extension. Then you subtract it from the total value of the asset. Then you now know your value of the asset as at the date of the extension. Since the extension is going to extend the useful life and also improve upon the production capacity of the asset, you have to add the extension cost now to the value of the asset as at the date of the extension. Then the next question is, what is the total useful life of the asset? How many years have I used? What is the remaining useful life? Then you use the new value after extension now over the remaining useful life to depreciate the asset. That is basically what they are asking us to do. All right. I think we can move on to the next question. Okay. Next question, question 5. Question 5, Kafui.
Roy Company acquired a brand new property, land and buildings on 1st January 2016 for $40 million, including $50 million in respect of the land. The asset was revalued on 31st December 2017 to $43 million, including $16.6 million in respect of the land. The building's element was depreciated over a 50-year useful life to a zero residual value. The useful life and residual value did not subsequently need revision. On 31st December 2018, the property was revalued downwards to $35 million as a result of the recession, including $14 million in respect of the land. The company makes a transfer from revaluation surplus to retained earnings in respect of realized profits. Required, calculate the amount recognized in profit or loss and in other comprehensive income for the year ended 31st December 2017 and 31st December 2018.
Okay. So the first thing is that if you have question that is involving PPE and there's a revaluation, the first thing that you have to ask yourself is, when was the revaluation done? In this particular place, in this particular question, the revaluation was done twice, isn't it? When was the first revaluation done?
On 31st December 2017.
When was the asset acquired? When was the property acquired?
1st January 2016.
How many years after acquisition?
2 years.
2 years, isn't it? All right. So the next thing that you have to ask yourself is, what is the value of the asset as at the date of the revaluation? What is the current value of the asset as at the date of acquisition? That is the current value that you are going to compare with the revalued amount. But the property was bought for 40 million, isn't it? So the property was for 40 million. Property was for 40 million. And they say land element is how much?
No, please, I'm lost. Which question are you solving?
I'm solving question 5.
On which one?
Property, plant, and equipment.
Okay, thank you.
All right. So they say the property, the total cost is 40 million. Land element is how much? What is the land element? Including land of 15 million in respect of the land. So land is 15 million. If land is 15 million, bidding will be how much? Building is how much?
Please, can we see the question again?
25.
Okay. Building will be 25. Okay. So let's move on. So they are saying that the asset was free value on 31st December, this and this. Okay. We have to know our value as at the date of that particular period. Okay. The building's element was depreciated over a useful life to a zero residual value. It means that as at the date of acquisition to the date of revaluation, the building has been used for how many years?
2 years.
It has been used for what? 2 years. So what will happen is that you have to find the depreciation on the building. What will be the depreciation on the building?
50 years.
What will be the depreciation? How do you get a depreciation for the building? It is a cost over the useful life. Am I correct? Am I correct? So how much? Depreciation is how much per annum? Depreciation is how much per annum?
0.5.
0.5 per annum. But how many years did we use it?
2.
So we multiply by 2. So the total depreciation for
1.
2 years will now be 1, isn't it?
Yes.
Okay. So let's look at the carrying value of all each asset at carrying value. Let's look at December 2017. December 2017. What will be the carrying value of the building elements? What will be the carrying value of the building?
24.
24, that is 25 minus 1. What of the land?
15.
16.5.
Carrying value is what? 15. Land, we are not depreciating the land, so the value at the beginning will be the same as the value at that particular year. These are carrying amounts. Let's count to the revalued amounts. What are the revalued amounts for land? Okay, let's take building first.
Land is 16.5.
Okay, let's take land. Land is how much?
16.5.
Okay, 16.5. And building is how much? Building is how much? The asset was revalued to 43 million, including land, which is 16.6. So building will be how much?
26.4.
26.4. Okay. 26.4. Okay. How do we calculate revaluation surplus or gain? Revaluation surplus or gain is calculated as what? The revalued amount minus what?
The carrying.
The carrying amount.
The carrying value as at the date of the revaluation. So let's do this for land. What will be the revaluation surplus for the land?
1.6.
The surplus will be the 16.6 minus what? 15. And that will give us how much?
1.6.
1 point what? 6. Let's come to
6.
the building. What will be the revaluation surplus for the building? It will be 26.6 minus what?
25.
Minus 24. That will give us
2.6.
2 point what?
6.
Okay. 2.6. Okay. What is the first requirement? The first one is saying that we should.
Let me see the depreciation figure for the land, the building, the first 2 years. Let me see.
Okay.
Okay.
So the question is saying that we should show statement of what? Statement of profit or loss for the year 2017 and 2018. So let's go and show that particular extract over there. So let's show the profit or loss first. Statement of profit or loss. Profit or loss. It will be 2017 and 2018. So 2017 should come first, 2018 should come next. Okay. So 2017, what will be the first item? It will be the depreciation, isn't it? We are going to have a depreciation of how much? How much is the depreciation?
And
How much is the depreciation for 2017?
1 million.
No, the 1 million is for 2 years.
0.5.
It will be 0.5. Depreciation will be 0.5. Every year is 0.5. Okay. Let's come to other comprehensive income. Other comprehensive income. Other comprehensive income. Okay. We are going to have revaluation surplus, isn't it? 2017 and 2018. So our surplus will be how much? Should we do it separately for building, or should I do it for all of them?
Total will be 4.2
No,
million.
the building element is supposed to be 26.4. The revaluation is supposed to be 26.4. 43 minus 16 point, this one is how much? (43 minus 16.6 is what?
26.4.
Okay. So what will be the total revaluation? 1.6 relating to land, 2.4 is relating to what? Building. So the total will give us what? 1.6 plus 2 point what? 4. And that will give us how much? Total will give us what? What will be the total?
Three.
The total is what?
3 and 4.
GM. Okay, GM.
Linus, sorry.
Value in 2018 or 17.
GM. Someone is raising up his hand.
Yes.
Yeah.
Please, was the asset revalue in 2018 or 17?
Yes, at the end of 2017, that was the first revaluation. 2018 it was revalued. So we are doing 2017 first before we come and tackle the 2018.
Okay, then please, can you come over the revaluation for 2017, madam?
The 2017. You said I should do what? GM, I can't hear
Please,
you.
can you come over that area?
Okay.
That side, please.
When was the asset bought? January 2016, isn't it?
2016.
Okay, the
Yes.
asset was revalued on 31 December 2017 to what? 43 million, isn't it?
43.
Okay,
Yes.
on the date of acquisition to the date of revaluation, how many years did you use the assets?
2 years.
2 years. So how do we calculate revaluation gain or loss? We compare the revalued amount with the what? With the carrying
Carrying
value.
amount. Yes.
Okay, so for us to, we are depreciating only building, isn't it? So land will still be the
Yes.
original value. So for us to know the building,
Yes.
which is 25 million, we need to depreciate the building over 50 years and we take 2 years out of it, isn't it?
Yes.
So if you depreciate the building over 50 years, 1 year is how much?
1. It's
1 year is
0.5.
0.5. It means that 2016 was 0.5, 2017 was what? 0.5.
0.5.
Are you okay? Okay.
Yes.
But out
Thank
of
you.
the revaluation, out of the revalued amount, 16.6 is relating to the building, isn't it?
Yes.
But the value of the building is still the 15 million.
Okay.
So what will be the revaluation surplus in relating to the land?
$1.6.
Okay. So if you come to the revalued amount is 43, 6.6 is for land. What will be the value for building?
26.4.
Okay, what is the current value of the building as at the date of revaluation? It is the 25 million minus 1 million depreciation, isn't it?
Yes.
So that will give you how much?
Minus 24. 2.4.
That will give you 2.4.
Four.
That will be the revaluation, isn't it? So
Yes.
the total revaluation surplus for 2017 will be 1.6 for land, 2.4 for what? The
Okay.
building,
Thank
isn't
you.
it?
Yes.
Okay. So
Thank you very much.
in 2017, we are going to have 4 million as the revaluation surplus. Okay. What will be the new value of the building in 2018? At the beginning of 2018, what will be the new value of the building?
26.4.
Okay. After revaluation, the original value is gone. The asset is now born again. Okay, the asset is now born again with a new name. All right. So if they are calling you Thomas, that you are born again, they are calling you maybe Jonas now, it means that Thomas is gone. So after the revaluation, the revalued amount now becomes the actual value of the land or the asset going forward. But what was the original useful life of the building? What was the original useful life of
50
the building?
years.
It was what?
50 years.
But we have used how many years?
2.
So the remaining useful life will be what?
48.
48 years. Okay. So at the beginning of 2018, the remaining useful life of the building will be 48 years, isn't it?
Yeah.
When was the next revaluation done?
Please, can you scroll up a bit?
Okay. When was the next revaluation done? When was the next revaluation done?
31st December 2018.
2018.
So that means 1 year after the first revaluation, isn't it?
Yes, please.
So it means that we still use the building for 1 year before the revaluation. So if you want to know the carrying amount as at December 2018, you still have to depreciate the building for additional 1 year, isn't it? All right. That the depreciation will now be the new value over the remaining useful life, which is 26.4 divided by how many years?
48.
48 years. What will be the value?
$0.55.
0.55. What will be the carrying value as at December 2018?
$25.85. 25.85.
Okay. So the carrying value will be 25 point what? 85. So at the end of this one, we do our next revaluation, isn't it?
Yes, please.
After the revaluation, what is the new revalued amount now?
Um, 35 million, but that for land is 14.
And that of the building will be what?
21
Okay.
million.
So December 2018, we did additional revaluation. So land will be 14 million, isn't it?
Yes, please.
And building will be-
Linus,
yes,
please. Help me to 2017. Let me look at something.
I can hear you.
At the top,
Okay,
2017. I want to check something.
okay.
So Linus, see the depreciation.
Okay,
The depreciation was 0.5. Okay.
all right.
That is 0.5. Every year is 0.5.
Yes,
Am I right?
you are right.
So why didn't we use that one and then we are dividing it again by the 48 years?
2017 is different. 2017, 2018 is different from 2016, 2017 is different from 2018. The 2016, 2017, in those years, the asset was not revalued. That is why we are charging the depreciation on the original amount. By the end of 2017, the asset has now been revalued with a new amount, 26.4. So it means that the new value of the asset from December 2017 into the future will now be 26.4. But the total useful life of the building is 50 years. We have used 2 years already. It means that the asset will now be having 48 years, which is the remaining useful life for the new revalued amount, which is at 26.4. So after you revalue the asset, the original cost is gone. The asset is being born again. It's a new asset now with the revalued amount. So you now take the asset as a revalued amount and depreciate it over the remaining useful life. So you can't be taking the 25 again. 25 was there. After no revaluation. After revaluation, we now have 26.4.
So anytime there's a revaluation, the depreciation figure will change.
It will change. So anytime there is a revaluation, after the revaluation, the revalued amount becomes the new value of the asset. Are you okay?
Yes, please.
Okay. Okay.
Thank you.
All right, you're welcome. Okay. So what will be the carrying amount of the land as at December 18?
As of December 2018,
what will be the carrying value of the land?
16.6.
Okay, 16.6. So the land will be, carrying value of the land will be 16.6. But now they are saying that what? 16.6. Now what is the new value of the land now?
Hold on.
40.
14 million.
So what is happening?
There is a revaluation loss.
Of how much?
2.6.
2.6, isn't it? Let's come to the building. What is the carrying value of the building as at December 2018?
35. Oh. No.
21.
21.
That is the revalued amount. The carrying amount is the 26.4 minus the 0.55. Is it 25.85?
Yes.
So that should be the current amount, but they are now saying that it's 21. So what is happening?
There's a loss.
A loss of how much?
Revaluation loss.
4.85.
4.85. What will be the total loss?
7 point something.
7 point.
7.45.
45.
Okay. 7.45. Okay. Okay. So how would this loss be shared? Some will be taken against the initial gain, and the remaining will go to profit or loss, isn't it? All right.
Yes.
Let's come to some part of the question. The company makes a transfer from revaluation surplus to retained earnings in respect of realized profits. Okay. So which we have two assets, isn't it? We have land and building, isn't it? Which of these assets revaluation surplus are we going to be making the transfer from?
The building.
The building. We make the transfer from only the assets that are depreciable. The transfer will be made from only the assets that are depreciable. What is the revaluation surplus in respect of the building?
2.4.
And this 2.4 will be realized over how many years?
You said it will be realized over how many years?
Yes, how many years are we going to use to take it?
The rest of the years.
Which is how many years?
48.
48. So for you to find the revaluation, so the transfer for every year is 2.4 divided by the remaining useful life. 2.4 over 48 is how much? Is how much?
0.05.
Which is the same as the difference between the initial depreciation and the depreciation afterwards. Revaluation. The initial depreciation was what? 0.5, isn't it? But the new depreciation for 2018 is 0.55. The difference is how much?
0.05.
Okay, so I would always advise you for you to know the annual transfer, take your revaluation surplus divided by the remaining useful life of the asset. Forget about the excess depreciation part. Are you okay? All right.
Linus, please take that side again.
I'm saying that for you to know the annual transfer that you are going to do every day from or every year from the surplus to the retained earnings, take your revaluation surplus relating to the depreciable asset divided by the remaining useful life of the asset after the revaluation. So that will be 2.4 divided by 48. It means that the 2.4 will be realized over the 48 years. And we are making this transfer because if not for the depreciation, the annual depreciation will have, if not for the revaluation, the annual depreciation will have been 0.5 every year, isn't it? But the revaluation is now bringing additional depreciation of 0.05, which is reducing our profit. So for us to neutralize that, let's make that excess depreciation figure from the revaluation surplus to retained earnings to neutralize the profit element, because the revaluation is bringing additional depreciation, which is reducing our profits. If not for the revaluation, the depreciation for each year should have been 0.5, but you are now saying that depreciation is 0.55. Where is the 0.55 coming from? Where is the 0.05 coming from? It is as a result of the revaluation that we did. So we have to be making that particular transfer from the revaluation surplus every year to cancel the effect that the revaluation is going to have on our profits. That is why they do the transfer. All right. So let's come here. After the transfer, are we going to have 4 million again? The 0.05 will be transferred from what? It will be transferred from the revaluation, isn't it? The 0.05 will be transferred from the 4 million. So after the transfer, how much do we have here?
No, let me see. Let's see.
After the transfer, how much should we have there?
3.95.
3 points.
3.95, isn't it? Okay. So in the other comprehensive income, the revaluation surplus amount left there now is what? 3.95. Okay. If it is 3.95, the total revaluation loss for the year is what?
3.45.
The total revaluation for the year now in 2018 is how much? 7.45.
Yes.
Okay. Out of this 7.45, we will send 3.95 to other comprehensive income to go and cancel the remaining gain over there. And the remaining part will go to where?
Profit or loss?
Okay, so find the difference and give it to me. Let's move on. So,
3.5.
so we bring 3.95 over here to neutralize because they have transferred 0.05 from that one. So, okay. So the loss, the revaluation loss will come here, which will be 3.5, isn't it? We bring the 3.5 here. Are we going to have depreciation for 2018?
Yes.
What will be the depreciation for 2018? 0.55, isn't it? All right. This is all the question is asking you to do. Very simple. Very simple, like ABCD. All right, let's move on to the last question, which is last sitting.
Learners, please. So I want to
Right.
see the projection of the profit and loss.
Okay. Profit or loss, we have the first depreciation 0.5, which is 2017. The second depreciation will be for 0.55 for 2018. Then the loss, which is the revaluation loss, is the difference that we are bringing here. 3.95 out of the 7.45 will go to other comprehensive income to cancel the previous gain. The remaining figure, we can't put it there. We have to send it to profit or loss because the revaluation surplus on the other comprehensive income is 0 after deducting that. All right.
Okay.
So Linus,
Thank you.
always we should do the presentation like this.
Oh, anyhow you want to do it. I'm not examiner for the ICA. So anyhow that you do it, that it will be okay. You are fine. The only thing is you just be showing the correct figures. That is all. Are you okay? Kathy,
Okay.
are you okay?
Yes.
Okay. But this one, for you to save time, you can do it like this and do your workings and come and put it there. All right. Let's look at the last question, which is the PPE question for last thing. Who is saying the whom there?
It's me. Oh.
Okay, maybe you're very fine. Okay, the questions are plenty. I can't solve all. Let's come to question 12. Kafi, I don't have to be mentioning your name before you'll be reading for me.
Okay. Lana Limited
Okay.
is a public listed company in Ghana.
Okay.
The company is located in the northern region of Ghana.
Okay.
The company operates in the manufacturing sector of Ghana.
Okay.
The company prepares its accounts to 31st December each year.
Okay.
During the year ended 31st December 2021, Lana Limited built a head office.
Okay.
The costs associated with the construction of the head office are as follows.
Okay.
Fees for environmental certification and building permits,
Okay.
0.5 million.
Okay.
Leasehold land acquisition, 10 million. Architect and engineers fees, 1 million.
Okay.
Construction material and labor costs, including unused materials, 6.5 million.
Okay.
At 31st October 2021, the date when the head office extension became available for use. At 31st October 2021, the date when the head office extension became available for use, the cost of unused materials on site amounted to 0.5 million
Okay.
Ghana cedis.
Okay.
At that, the total borrowing cost incurred on the loan, which was used to specifically finance the head office extension, amounted to 0.5 million.
Okay.
The estimated useful life of the building was 40 years.
Okay. Perfect. The requirements.
Please, I can't see the requirements.
Okay.
With reference to, oh, you can, it's down there, isn't it? Before the 13.
Kathy, read. Since you can see, read for us.
With reference to IFRS, says determine the initial cost to be capitalized, the depreciation charge for the year and the 2021 31st December, and the carrying amount as at 31st December 2021.
Okay. All right, seniors. So this was a question before my people. That was 30th March 2023. Question 5. You see, can someone spot a mistake in this question?
A mistake?
Yes.
I see.
I'm not saying that the question is not correct, but there's a mistake in it. You are telling us that the company built head office. Now you are telling us that when the extension becomes available for use. Extension and building, are they not two different issues?
They are two different
It
things.
means that they have copied the question from somewhere, but they didn't do their editing work.
The editing work.
Okay. But let's assume that they are building, isn't it? Okay. So if they are building, we ask ourselves, what are those costs that are necessary for the building to be in the state for its intended use? The first thing that you have to do is that sometimes if you are building, they will come and they'll say produce permits, stop work or something, isn't it?
Yes.
So the first thing is that without the fees for environmental certification and building permits, the building cannot take place. So this will be part of the cost of what? The assets. So let's look at the initial cost of the assets. The initial cost of the assets, initial cost of the building, which is the assets. Okay. So the first one will be the environmental certification and the rest. Okay. The cost is how much? The cost is how much? 0.5 million.
0.5 million.
Okay. 0.5 million. So we have 0.5 million. What will be the next item?
The land and leasehold land acquisition.
Okay. The land, without the land, you can't what? Build. Are you going to build in the air? No. So the land will come, you can't cost. The land is how much?
10 million.
10 million. What else?
The architect and then the engineer's fee.
Please, without their plan, you can't go ahead. And with their site surveying and those things, we can't go ahead. So this is also a relevant cost to the building. How much is that? 1 million.
1 million.
Okay. The next one is what?
The construction material and labor costs.
Including
But it
what?
says it includes unused material.
Okay. So the unused material, that particular cost was not spent on the building. So we have to find the cost of the unused material and subtract it from the cost of the material and then the labor. So on the unused is 6.5. So let's pick the 6.5 first before we come and subtract that particular one from it if we are now given that particular one. So let's come here. At 31 October 2021, the date when the head office extension become available for use, the cost of unused materials on site amounted to what? 0.5. It means that the cost of the material used on the building and the labor cost is only what?
6.
Is 6 million.
6 million.
So you have to come and take the cost of the unused material. That is not part of the building. It wasn't used. So it is not used on the building. Cost of unused material, which is 0.5. 0.5. You take it from that one, 0.5.
So Linus, can you take it out straight away?
Yes, you can do that straight away. Are you okay?
You can just write
You can just do
without bringing the cost of unused. You can
Yes.
just take it out from the
and bring the 6.
6.5.
I bring only the 6 to that place. Are you okay?
Okay.
All right. So the next one is what? At that date, the total borrowing cost incurred on loan which was used to specifically finance the head office extension amounted to 0.5. We are incurring this particular interest as a result of we taking the loan to construct the building, isn't it?
Yes.
Therefore, the 0.5 should be added to the cost of what? The building,
Yeah.
borrowing cost. All right. So you can name it borrowing cost. Anyhow you want to name it. The only thing is the 0.5 should come. So if you want to name it your name and put a 0.5 there, we don't have any problem. Okay. So what will be the total cost?
This one there is just something simple.
What will be the total cost?
18.
It will be 18 what? Million. All right. It will be 18 million. So when did the building becomes available for use?
31st October.
And when is the reporting period for this particular company?
31st December.
December.
So how many months after? How many months was used for the usage? For how many months was the asset?
3 months.
November, December.
2 months.
It was
2
used
months,
for only
sorry.
2 months. Are you okay?
Yes,
Alright.
please.
But you know, I'm going to make certain arguments over here. But next time you go and see a question like this, come to leasehold land acquisition. Leasehold land acquisition. Someone can assume that, okay, you want to build or you want to construct a building on the land. So you want to take the land for 40 years. Someone can have that particular argument. Are you getting it? That's why I'm saying that they should just make it land acquisition so that we know that, okay, it's just a pure land which is going to have an indefinite useful life. But you are saying that leasehold land acquisition. Someone can make the argument that, okay, since I'm going to build on the land, I'm going to pay maybe these people. Maybe how do they call those people? Those people that they have been giving the land to those people. How do they call them? Is it land commission? Okay, so you can go to land commission and get the land for 40 years and you pay 10 million. Okay, someone can also say since the building will be for 40 years, then that means they are also going to use the land for 40 years. That is someone's argument. If you should make this argument in the exam hall and state the assumption, they can mark it. But since you are going to see acquisition, it means that you are acquiring the land for yourself. Although it's leasehold, but since it's land acquisition, someone can also say that, okay, first you are leasing the land. Now you have acquired it permanently. Are you okay? So in this case, we are going to assume that the land is having indefinite useful life. But they should have just make it land acquisition, and we are not going to have any problem with the assumption. Someone can say, okay, you want to construct a building for 40 years, so you go to land commission and take the land for what? 40 years, and you pay 10 million. So the person is going to depreciate the land also for 40 years. All right.
Yeah, that was what I was thinking because of the estimated useful life of the.
Yes, if you have that assumption in the exam, nobody is going to penalize you because the question wasn't clear. Leasehold land acquisition. It means that you are building on someone's land and you have to go and take the land for 40 years. You are paying 10 million. So after the 40 years, you won't have the land again. So someone can depreciate the land over 40 years. Are you okay? But someone can also make the argument that, okay, first you were leasing the land. Now you want to acquire it for yourself. So since you are acquiring it for yourself, it's for indefinite useful life. So you're not going to depreciate the land. That's why I'm saying that these things make it clear for people to not to be thinking. Are you okay? All right, yeah.
Okay, please, if you were to consider the land to be leased for 40 years, what would have happened to the other items?
What would have been what?
Like, how are we going to trade depreciation for the rest, the building and the architect and construction?
You just
materials
divide
and-
all the total 18 by 40 and multiply the answer by 2/12. That's all. Because the land will also be considered to have 12 years, 40 years rather. Are you okay? So you depreciate the land together with all the thing. They are all having 40 years life.
That is what I did though, so that's why I'm asking you that. That was what I was thinking.
Okay. That particular assumption, if I'm an examiner, you are making that assumption, I'll mark it. Because the question wasn't clear enough. Just make it land acquisition. But leasehold, lease. The person can say, okay, this is a company which is operating the northern region and they don't have this one. They go to a land commission to take the land for 40 years and they pay 10 cedis. They pay 10 million. So it means that after the 40 years, they are not going to have access to the land again. It is something. Let's move on. So let's assume that we're not going to depreciate the land. So the building, the cost of the building will now be what? How much? The land is 10 million. So the cost of the building
At the borrowing cost, Linus, it's not
Yeah.
5.
is 0.5. Borrowing cost is 0.5.
Where is the 0.5?
See the Ghana city well amounted to Ghana city 0.5 million.
The borrowing cost.
Yes.
At that date, the total borrowing cost incurred on the loan, which was used to specifically finance the head office extension, amount to 0.8 million. Am I right?
No. That means you are reading a different question.
You said last sitting exams.
Yes, your own was 0.8.
Yes.
My own was 0.5.
I'm reading. I'm reading from the source.
You are reading from the source.
The original source.
Okay, then it means that I'm the one, the time that I'm tapping the question, then I made a mistake in the question. I also have the original source. It was 0.8, sorry. Sorry. I was the one who made a mistake to be 0.5. But at the end of the day, it's the same treatment. Are you okay? All right. I made a mistake to make it 0.5. Okay. So what would be the building elements? Building element will be what? If we are taking the land out, the building element will be what? The remaining cost after taking the land out is how much? That would be 8 million. Okay. So our depreciation will be depreciation will be equal to 8 million over 40 years, all times 2/12, because the asset becomes available. Jim, are you raising up your hand again?
Yes, please, how did you get the land element?
Oh, the land element is in the question already. Land is
Okay.
over here. Land is 10. Can you see the 10?
Yes.
Okay, so we just take it from the total cost, which is 18 million. Then we have 8 million as the figure. Are you okay now?
Yes, thank you.
Okay. So the the building was used for only 2 months, which is November, December. So you have your 8 million over 40 years times 2 over 12. That will give you your depreciation. That will be the depreciation charge for the year. All right. So I'm thinking that we are done with PPE now. The questions are there. If you have any problem.
I want to check something. Leonard, please go back. I want to check something.
Okay.
You took our question and you polish it. Eh?
No, I was it was a typing one. I was typing.
It was what?
It was maybe it might be this thing, an oversight.
Okay. I just want to see the concept. Don't worry about the figures. I just want.
Okay.
Okay, so you need to take the land portion from it because land does not be. We don't depreciate land.
It's not that we don't depreciate land. The assumption is that land is going to have an indefinite lifespan. It will be there forever. But if you know the useful life of the land, you can depreciate it.
So they can give you a useful life for the land.
Exactly. Yeah. I mean, the last time I was telling you that the mining people, I mean, they will give them the land, they are going to lease the land for them for some years. After that number of years, they will give the land back to the people, isn't it? So
yeah, the assumption I've always been having is like we don't depreciate land.
That is what they told you. But I thank God that you are here and I'm telling you that that assumption is not absolute.
Yeah.
Okay.
Yeah.
Okay. So let's move on to the issue of the day. Income tax. Income tax. All right.
It's also criminalized.
Yeah, income tax, it will count.
It came twice as a standard on its own.
Yeah, it will count to console the corporate reporting too. So let's come to income tax. You see, basically you see that every country has a different tax system, isn't it? If you come to Ghana, the way we operate our tax system is different from if you go to Togo. It's also different from if you go to Nigeria. But whatever is the issue, all these countries is going to have one way of accounting for the tax, one way of doing their tax. So the IS12 although the IS12 is not trying to harmonize how countries to go about their tax systems. No, you can still use your tax systems. But at the end of the day, there will be something in common that all these countries, they are going to have a way in common that they are going to do accounting for their tax estimates. So the IS12 is just trying to educate us about those principles, those general principles that we can see. So if you go to Nigeria, it is estimated of every company that at the end of every year, they should make an estimate for the tax that they are going to pay. It can be based on their previous performance. They can also based on that particular forecast of the year and do their tax estimates. What normally happens at the end of the day, it can happen that the estimate that they are making is more than the actual amount that they're supposed to pay. So if that happens, what will happen? If Ghana too, the companies are making estimates for the amount that they are going to pay at the end of the day, they are making a higher estimate. Nigeria too, they are making a higher estimate. You can see that both two countries are going to use one way of accounting for this particular higher estimate. So that is what the IS12 is trying to achieve, not that. Okay, Rashid or Rashad, why did you multiply the depreciation by 12? By 2 over 12. Okay. The question says that at 31 October 2021, the date when the head office extension become available for use. So they start
please
using,
go back and let's see how it is.
You said?
Can we see your board?
Can you see my what?
Your board, your screen.
Okay, sorry. Okay. The
solution.
Okay. After the table, what my boss is saying is different from what you are saying. Okay. The reason why I multiply the the depreciation by 2/12 is that the question is saying that at 31 October 2021, the date when the head office extension become available for use. So they start using the head office or the building from 31 October 2021. But the reporting period for this particular company is 31 December each year. So October, which is 31, is almost over. So they will start using the building from November and December. So they are going to use a building for only 2 months. But if you are doing 8/40, you are calculating annual depreciation, yearly depreciation. But we didn't use this particular building for the whole year. We use it for only 6 months. So we use it for only 2 months. But the whole year is 12 months. So for us to do it, we just multiply by the 2 over the total number of months. That is what I did. Rashid, I hope you're okay. Let's move on. All right. Okay. So I was saying that okay, you're welcome. I was saying that at the end of every financial year, accountants or financial accountants of companies, especially the public listed companies, are going to pay tax. Paying of corporate tax is one of the corporate or social corporate responsibilities of a company. It's one of the responsibilities, it's one of the legal responsibilities of a company. So if you are preparing your statement of financial position or your statement of profit or loss accounts, you can't wait till the tax authority give you the actual tax that you are going to pay before you come and recognize tax. No. It is allowed that from the beginning to the year end, you can look at your performance, your previous performance, and make a tax estimate based on those performance. Or you can look at your forecast now. Okay, this is the revenue that we want to generate at the end of the year. This is the expenses that we want to make. So this will be the projected profits. You can make estimate based on projected profit and put it in the financial statement as a tax estimate. After the year end, you are going to submit your financial statement to the tax authority of the country that the company is operating in. Now they will use the principle of wholly, exclusively, and that principle of necessarily to allow some of the expenditure and also disallow some of the expenditure. So you'll be saying that, okay, we didn't pay tax on time. We didn't pay tax on time. So the GRA, they give us a fine and we pay penalties. And you are saying that this is an expense to you. No, the tax law says that you can't deduct that as an expense. Negligence of the law is not an excuse. So the GRA is going to disallow that. You have done get together for your employees. How is get together, expenses on get together related to your activities? You are going to subtract that as an expense, but the GRA is going to disallow that. So they are going to use this allow-disallow principle to calculate the actual tax that you are going to pay for the year. This will always come after the year end. So the income tax is saying that don't wait till the time that the GRA will now give you the actual tax before you make your estimate. No, put estimate in the financial statement. And whenever the GRA give you the actual tax estimate, it can be the estimate that you make, it can be over or it can be under. Then you can adjust that. So the IS12 basically talk about 2 types of taxes. We have the current tax and also the deferred tax. We have the current tax and also the deferred tax. What do we call the current tax? What do we call the current tax? Kati, what is current tax? I know they will not ask you in the exam, but answer me.
Is a tax that the company will be paying during the accounting year.
Okay. That is nice.
Are you sure?
Oh, that is nice.
If everything is okay.
Okay. So if you talk about current tax, what we are talking about is that current tax is the estimated amount of tax payable on the taxable profit of the entity for the period. So the current tax, okay, if you are making a profit of 10,000, what is the tax that we have to pay on it? That is the current tax. That is the current tax. So I'm saying that the IS12 is allowing financial accountants of companies that, okay, since tax is one of the legal responsibility of the company, and you are not going to know this tax until you submit your financial statement to the tax authority of the country that you're operating in, just make an estimate based on the profit that you have made over the years, or based on the tax that you have paid over the years, or based on the future projection into the year, that this is the profit that we are going to make. So if this is the profit and the tax rate is 25%, just find the 25% on the profits. It might happen at the end of the day, that is not the profit that you are going to make. And some of the expenses, you need not to subtract them. GRA is going to disallow them and give you the actual tax. So just make an estimate. So the assumption is that, okay. Okay, so let's come here. For 2022, we make an estimate of 2022, make an estimate of 20,000. But this is the estimate that we are making in the financial statement. This is the estimate that we are making in the financial statement. This is the estimate that we are making. But the actual tax GRA has given to us, the actual tax that GRA has given to us is 22,000. Is 22,000. What is happening? We have underestimated, isn't it?
We have underestimated.
Okay, what is the effect? What is the effect of, okay, let me pick it that the profit for that particular year was, let me pick the profit for 2020. Okay, let me put profit first. Profit is 100,000. And our tax estimate was 20,000. So what will be the profit after tax? 80,000, isn't it? Okay. But at the end of the day, GRA has given us 22,000. So what should have been the actual profit after tax?
22,000. 78.
78,000. But what did you record as the profit?
80.
80. So what is happening?
We have underestimated.
So what will be the effect of the underestimate on the profit, on the last year's profit?
It increase our profit.
So if you want to adjust it now, what are you going to do?
What did you say, please? Come again.
If you want to adjust the profit now, what are you going to do?
What to do it in the retained earnings?
We subtract 2,000 from the 80,000 to have our 78,000. That should have been an adjustment, isn't it? But now we are in 2023. Okay. We are in 2023. You can't go back and be subtracting 2,000, which was underestimation from your profit, which was 80,000. You know why?
The account has been closed.
Is it?
You have closed that account.
No. Sometimes the accounts can be closed, but you still have to go and correct it.
If it will have an error.
Okay. Kevia, do you know why we are not going back to go and subtract the 2,000 from the 80,000 profit to make it back 78,000?
Because you've moved to a new accounting year.
No, please. If the person said that thing, then I'll close the meeting. Like we won't have the class again.
Retrospective and prospective error.
Habakkuk, do you know why?
What is that account? Hey, close the door.
Okay. What we normally do is that the 2,000 should have reduced our profits, which should have been 80,000, which is the profit made minus the the difference, which is the underestimation, to reduce our profit to 70,000. But we don't do that. We now take the underestimation to the new year now to go and adjust it against the profit for this new year. And I'm asking, why don't we go back because the 2,000 is not relating to the current year. It is relating to the previous year. So that should have been subtracted from previous year's profit, but we don't do that. Stefano, are you here?
Yes, I'm around. I just joined some 10 minutes ago.
No, I saw you on this call for a long time. They said that you have been worried.
Hey,
right?
Linus.
Okay. Let me mention the people that I know.
Hello.
Is it because the account would have been
Hello.
audited by now?
The account will be what?
Audited.
No, Kafi, you're my in-law.
Linus,
Yes, yeah.
I think that underestimation and overestimation are treated as an estimate under IAS 8. So when it happens like that, you have to treat it prospectively. You don't have to go to the previous year in order to treat it, but you treat it from the year like you don't go back and treat it again. That's what I think. But you continue your accounting year.
Okay. You have passed the paper already. So by me, I have declared you as a student who has passed the exam already. But if you don't want to pass, that is your
Amen. Amen.
Okay. We do this because this is an estimate. So it is treated as a change in accounting estimate, a change in an estimate under accounting policy.
Yes.
Yes. So it's an estimate, it's an estimate that you are making. So it can be correct, it can be wrong. So it's because this particular one is an estimate. That is why we don't go back and subtract the 2,000 from the 80,000. We now adjust it against our current year's profits. Are you okay? All right.
Okay.
The same thing for the overestimation too. If our profit was 100,000, okay, so if we want to add the 2,000 to our current year's profits, if I say we add, if we want to adjust it against our current year's profit, what are we going to do? Are we going to subtract what we add?
We're going to subtract.
We are going to subtract from the profit, isn't it?
Yes.
Okay. But tax will also be subtracted from what? The profit, isn't it?
Yes.
Okay, that is where we always add the underestimation to the current year's profits.
Yes.
Because they are all going to be subtracted from the profit. Okay. So let's come here. The profit for the year was 200. So we are estimating 78,000. Okay. And the GRA has given us the actual tax of what? 80,000. It means that the profit should have been what? 80,000, but we are reporting what?
Linus, use a different figure.
Okay, you can do the example in your book and use a different figure. Let's move on. Let me use 25 and 17. So this is 75, isn't it? Okay, we do an estimation of 25 and we are getting a profit of, okay, Nana Yao.
Yes, sir. Good evening.
Yes.
I just joined and I want to get some clarity here.
Okay.
You said there was a profit of 100,000.
Yes.
And then an estimate of 20,000. No problem. But the way the 2022.
I'm listening. Is the chat talking from your side?
So,
let's move on. Talk. I'm listening.
Yeah, I'm saying that
yes,
you gave the 2022 that there's an estimate of 22,000.
Okay.
And then we have the 78.
Okay.
But how we got the 25 coming into the 2023? That is where my challenge has been.
Oh, my sister said I should use a different figure, so I'm using a different figure.
It's just an estimate.
Are you okay?
Oh,
So
okay.
she said I should use a different figure because she's going, if you are using one figure twice, she normally get confused. So that's why I've changed the estimate to
Is
25.
that what I said?
So it's just another.
Are you okay? So we are making an
Yes,
estimate
okay.
of 25,000. So we subtract this from our profit, we are getting 75,000, isn't it? By the end of the
Right.
day, GRA has given us 20,000. It means that if we should have known that the actual tax will be 20,000, we should have been reporting a profit of what, 80,000.
Yes.
Yes.
But we have reported a profit of what, 75,000. What we have to do is that it means that we have subtracted more than we should.
Yes.
So we
And
just
so
go
we
and
have
add the
to
5,000 to this and make it 80,000 as a profit now. Are you okay? But we
Yeah.
don't do that because this is an estimate. So we adjust it against our current tax. The effect of the 5,000 on profit is that it's going to increase the profit, isn't it?
Burden, yeah.
Okay.
Yes.
But the tax is an expense. The current tax is an expense which will be subtracted from the profit, isn't it?
Yeah.
But the
Mhm. Yes.
5,000 is an income that we have to go and add back. So if the current tax is now 25,000, which is the current estimate now, what we do is that we should have added 5,000 to our 75,000, but we haven't done that. That is income. So we have to come and subtract it from our current tax now to make it 20,000. So the income that we have to go and add to the 75 that we didn't add, we net it against the current tax. That's what we do.
Oh, okay.
Over provision is treated as an income. Are you okay? So
Okay, so it will reduce our tax burden
exactly,
for the year.
exactly.
Okay.
But if it is an under,
Linus,
yeah, if it is under provision, it means that, yeah,
So please, with what you're explaining, are
okay,
you saying that when there is an over provision,
yes,
you said we treat it as an income against the tax
yes,
element?
yes, we subtract it. That's what we do.
Oh, okay.
Because you have subtracted that
So
portion of your
the
profit,
accounting
which should not be
entries,
subtracted.
how will it be?
Is that?
In the entries, for accounting entries, how will it be? What will be the entry? What do
Okay.
we credit and debit?
You are talking about the old school accounting format.
Yes, the
1993 one.
entries.
1993
Yes.
one, isn't it?
Yes.
Don't worry, I'll show that one, and I'm going to show something. When you have the balance on the debit side of the trial balance, what does it mean? If you have this balance at this side, how does it mean? I'm going to show that. All right.
Okay.
So don't worry. Okay, so this is what we call under provision and over provision. When the tax estimate is higher than the actual tax amount to be paid, we say that was over provision. I think it should be deducted from 20,000 instead of
Yeah,
25,000.
it's true. It's true. The actual is 20,000.
No, we are giving us
The GRA one is 20,000.
that is for last year.
So we
It is for
reduce it.
last year. The actual tax we are going to get the last year in the new year. That is what normally happens.
Okay.
So if you are doing the estimate for the tax that you are going to pay for 2023 now will come in 2023. Are you okay?
Yeah.
Okay. So it's supposed not to happen like that. You only know your tax, the tax liability when you have submitted your final accounts, your books to them. So maybe this one, I mean, they normally file this thing maybe April or first quarter or something like that. So it will come that time that you
Then they'll also audit it before they'll give you your tax
Yes.
liability.
Yes. So this one normally comes after you have submitted your financial position. Are you okay? So let's look at
Yes.
what we call under provision and over provision. Under provision is where your estimate is lower than the tax that you're supposed to pay. That is under provision. But over provision is where your estimate is higher than the actual tax that you pay. Are you okay? Okay. Okay. So let's show the double entry for this fast. Let's say that the estimate is what? The estimate is 25,000. Are we okay? This is the estimate that we are making.
Mhm.
Okay. So this estimate will be subtracted from our profit, isn't it? And
Yeah.
the assumption also is that this is the amount that we are going to pay GRA at the end of the year. Are you okay?
Mm.
So this now becomes an obligation to us. Therefore, it should be also recognized as what? The 25,000 is the amount that you are saying that you are going to pay GRA, isn't it? At the end of the
Yes.
year, have you paid GRA? At the end of the year, have you paid GRA?
Not yet.
No.
So you are owing them, isn't it?
Yes.
So this
Yes.
will be treated as what?
A liability.
Which of the liabilities?
Current liability.
Okay, so we assume that the payment will be done maybe in 4 or 3 months' time. So this is a current liability. Okay. So this will be treated as a liability. Okay. At the end of the year,
Please come again.
come to you or where?
Me, what you said, please, can you go over again?
Okay. I'm saying that Kati, if you are the accountant for Kati Corporation Limited, and you are making, at the end of every year, you make an estimate of a tax that you are going to pay to GRA. So we are saying that the estimate is 25,000. This is the amount that you are saying you are going to pay to GRA, isn't it?
Okay.
Mhm.
So the assumption is that you are going to pay GRA 25,000. Have you paid them at the end of the year?
No.
So it means that you are owing GRA in your books. You assume that you are owing GRA 25,000, isn't it?
Yes, please.
Yeah.
This should be recognized as a liability. That's what I'm saying.
Okay.
Current liability.
Your tax liability.
Yes. We assume that it will be paid maybe within or 3 months after this one. That is why we say it will be a current liability. But let's
Okay.
assume that during the year you have paid 20,000, which is the final tax for the year that you are making an estimate for. Let me put 2022 over here. So you have paid 20,000 as the final tax and the final settlement of your tax relating to 2002. It means that you have overestimated, isn't it?
Yes.
Let me show the double entry for this. Let me show the person who is saying that I should do the 1992 accounting this thing. Let me do that.
You're always teasing us.
Current.
Oh, don't mind it.
They should not mind me. They say what I'm saying will not mind you. Okay. So we are going to have debit should be where? Okay. Let me put the currency sign here. And let me put the currency sign here. So the estimate is a liability, isn't it?
Yes.
So the liability will be at the credit side, isn't it?
Yes.
Okay.
Credit balance.
Which will be 25,000. Are we okay?
Yes.
So if you pay, what will happen? What will be the double entry if you pay?
Mhm.
You
credit
debit
your
it and
cash
credit the cash.
and debit what? The
Yes.
credit tax
The
account.
liabilities.
Okay, so you say cash or
Yeah.
bank. So you say cash or bank. Is how much?
The amount you pay, 20,000.
20,000. But they are saying that after paying this, you are not owing GRA again. Are you getting it? Okay.
Oh, okay.
So what are you going to have? We are going to have where are we going to put the balance to balance the accounts?
P&L
At
or
the
what?
debit.
The debit side.
Under the
So we have
You
balance
write it up here.
balance carried
cash
down,
and
isn't
bank.
it?
Yes.
So we have balance carried down to be this one. Where would this balance be?
To
At
go to the
credit
P&L.
side.
And that balance is representing what? Over or under?
Over.
Over. So whenever you see or the question say the company has a credit balance relating to tax, knows that that is over provision for the previous year.
Mhm.
Okay. And also, if you see 5,000 or you see a figure relating to current tax on the credit side, these are the things that that particular figure means. The first one can be over provision. The second one can be the tax liability.
Okay.
Are you okay?
Okay.
Can I take the third one? Should I mention the third one?
Yes.
Okay, the 2 is okay for you. We are looking for the third one. All right. So it will either be over provision, the tax liability, or the third one, which we are going to look for.
These are the deferred tax.
No, the deferred tax, they are going to write it against that one, deferred tax, not current tax.
Okay.
All right.
The third one, the PNL.
No. You are going to look for the third one.
Third what again? Tell us.
Okay. So let me give you the 2. It can be over provision or the tax liability for the year. Okay. Okay. But if you see this balance, assuming the estimate that we made was only 20,000, and now they are giving us 25,000, it means that this place will be, the opening balance will be 20,000, isn't it? And this place will be 25,000. Where would the balance be to close this account?
To go to the debit, the credit side.
So we have balance carried down to be 5,000. So this will be, the opening balance will now be at the debit side, isn't it?
Yes.
But this is
Yes,
under
please.
provision. So whenever you see current tax on the debit side of the
Debit
trial
side.
balance, it's either under provision, tax paid, it can be the tax paid during the year, or a tax credit. Or a tax credit.
Okay.
All right. So it can be under provision. So
Okay.
always the question will tell you, those financial reporting people, those are writing the final accounts. The question will tell whether it is current, whether it is over or under. Whether it is over or under. So from this, let's
In the footnote.
yes, in the footnote, they will tell you something like that. Okay, let's look at this question.
So, Linus, please. So when they say that taxation account, and it's at the debit side.
Okay.
So it's that one too is under provision.
It's under provision. So by the question it is saying anything, you can think about 3 things: tax credits, tax paid, or under provision.
Okay.
Okay. But the question will always tell you whether it is under provision or over provision. Okay. Let's look at some question under or over. I'm done with the under and over. Let's move on. Okay. Question 1. Kathy, my reader, where are you? Kathy, are you there?
Yes, please, I'm here.
Okay, I'm waiting.
Okay, so IAS 12 income taxes set out guidance for dealing with under provision and over provision of income taxes by reporting entities.
Okay.
During the year ended 31st March 2019, the Links Limited finalized and paid its liability for March 2018 at an amount of 21 million Ghana cedis.
Okay.
It had previously made an estimated provision for corporate tax of 25 million Ghana cedis in the financial statements for the year ended March 2018. Liability for the year ended 31st March 2019 at 24.5 million Ghana cedis. Required. Explain the treatment of the above transactions in the financial statements of the Links Limited for the year ended 31st March 2019 in
Okay, don't worry. You have done well. Your network is now trying to say something, but we don't mind that. We have done well. All right. So during the year ended 31 March 2019, the Links Limited finalized and paid its liability for corporate tax on profit for the year 31 March 2018 at an amount of 21 million. So it means that in 2019, 2019 before I paid the tax relating to 2018, isn't it?
Yes, please.
Okay. How much did I pay?
21.
21 million. Okay. It had previously made an estimated provision for corporation tax of 25 million in respect of the financial statement for the year ended 31 March 2018. So what was the estimate that I made for 2018?
25 million.
And I'm not paying how much?
21.
What is happening?
There was an over provision.
Over provision,
Over provision of how much?
4 million.
4 million.
So it means that I've subtracted 4 million in excess from my profit for last year, isn't it? All right. The amount of
Yes.
tax that I should have subtracted should have been 21 million, but I've subtracted 25 million. I have to go and add back the 4 million, but we don't do that. That is a change in an estimate. Don't go and do that. So the only thing that you are going to do right now is the 4 million is subtracted from profit. So I have to add it back. So now it's just like the 4 million becomes a profit or an income to you now. All right. So if I'm estimating that I'm going to pay the tax authority 24.5 million this particular year, it means I have to take the 4 million from the amount I'm going to pay to them, isn't it?
Yes.
So that I'll be having 20.5. So always over or under provision is adjusted against the current year tax. Under or
Okay.
over provision is adjusted against the current year tax.
Okay.
Let's come here. Explain the treatment of the above transaction in the financial statement of the Links Limited for the year ended 31 March in respect of taxation. How are you going to explain this? How are we going to explain this? Kevia, how are you going to explain this? I have about 24 people here. No, myself, I'm excluded. 24. Stefano, Charlie, you're not talking today. What is the problem?
I joined not quite long, so I'm just observing things.
Again.
Yes, I don't even have the question you are reading. I don't have the questions. I don't know.
Don't worry, I'll send a question to you, but you can see the question on the
Okay.
board.
Yeah, I can. I'm using a phone, so
So
it's
don't worry,
appearing
I'll
small.
still send the question to you so that you read
Okay,
it
okay, no problem. No
and give
problem.
me the answer. Okay. Kati, how are you going to explain that? That is a corporate reporting question. No? Kati, how are you going to explain that?
I think we explained it the way we did the first question, the examples that you gave. I think we explained it the same way.
So give her the explanation. Okay. The explanation will be the difference between the 25 million, which is the estimate for the previous year, and then the actual amount paid represent what? Over provision, isn't it? Or there was over provision relating to the year ended 31 March 2018, which amount 4 million. Then you find the difference there, 25 million minus 21 million. So in the current year statement of profit or loss, the Links Limited is going to charge a current tax of 20.5. Then you put it in a bracket, 24.5, then you net the over provision against it. And in the statement of financial position, the Links Limited is going to represent 24.5 million as a current tax, which will be under a current liability. So for the year 2019, they are estimating that they are going to pay a tax of 24.5 GRA. So they are owing, technically, they are owing GRA 24.5. That's all. So you talk about the under or over provision, the effect that will have on the current or the profit or loss account relating to the current year estimate, and the current year estimate will be represented as a current liability in the statement of financial position. That's all. Are we okay? All right.
Linux, please,
Yeah.
I wish
Linus.
you could
Yes.
use the Excel to do the working so that at least we can follow.
I should do what?
Do the
There's no
workings on
working.
the Excel.
What? There is no working. What workings am I going to do here?
No, the subtraction and the
So do you
subtraction
agree
and the
that
current.
there's over provision of 4 million?
Yes, please.
How
Which is going to
did
reduce the,
how did you agree?
because we estimated 25 million, but we paid 21 million.
Okay. So we have over provision of what?
4
4
million.
million. Isn't it?
Yes, please.
If someone asks you mathematically, how did you get the 4 million?
I subtracted the 21 from the 25.
Okay, and that is what you want me to do for you. Okay, let's move on to the next one. Do you agree that the current year tax that we are going to pay, we are going to subtract the 4 million from 24.5?
Yes,
Say the
please.
yes, let's move
Yes.
on. Okay.
Yes, yes, please.
So you are going to pay a tax of, you are going to charge a tax of 20.5 in the statement of profit or loss account, isn't it?
Yes, please.
That is the workings that you want me to do for you.
Okay, please. I didn't get the first explanation. I'm okay now. Thank you.
Okay, you have to be okay. Let's move on.
So it means that we're going to explain it based on the effect that it will has or what it will have on the financial what do you call it, the profit and loss, and then the statement of financial position, right?
Exactly. And also,
Okay.
what does the difference means? That is what they are. You have to see that.
Okay.
Let's move on to the second one. Kathy, read for me.
Please, can you have someone read? I was trying to jot what you said.
I think the video is the class is being recorded, so the video,
Okay.
everything will be there. Oh.
Okay. Kevin, read for me. Read for me.
And my shadows, I can't be
watching.
Yeah.
Question number 2.
Yeah.
DLX Limited manufactures and distributes security equipment. DLX prepares financial statements in accordance with International Financial Reporting Standard, IFRS, up to 31st August each year.
Okay.
On 31st August 2019, the taxation liability account in the books of DLX Limited showed a debit balance of 17,500 Ghana cedis after paying the 2018 liability. The estimated liability for 2019 is 84,500 Ghana cedis, and no entry has been made to record this. Required. Explain the appropriate accounting treatment of the above transaction for the year ended 31st August 2019.
Okay. So that is what they are saying. They say on 31 August 2019, the taxation liability account in the books of the Links Limited showed a debit balance of 17,500 after paying the 2018 liability. So the debit balance means what? Over or under?
Linus, under.
Is what?
Under.
So this thing is Linus under. If you mention under, what am I going to say? You have to add my name. Oh.
Under provision.
Under provision, that's what I mean.
Okay. So it means under provision, isn't it? So the explanation will be the first one is that 17,500 is under provision relating to the previous year, which is 2018.
2018, okay.
All right. Then what will be the effect of under provision on the current year's estimates?
You add it to the current year's estimate.
Okay, so it means that
increase the tax liability.
Okay, so it means that the tax that you are going to send to statement of profit or loss will be 84,500 plus 17,000 what?
500.
Then you put it there. Then the current year estimate will be sent to the statement of financial position as what?
84,500.
As what?
84,500 current liability.
Okay, that is all. That is the explanation that they're asking you to do. That is all. That is all about the under and then the over. So under is treated as you should have subtracted the amount more, but you didn't subtract all. So the excess will still be subtracted. So treat it as an expense. You add it to your current tax. Are you okay? All right.
Oh, okay.
Let me take some question on current tax again so that we see how we go about it. The issue is the deferred tax. The issue is the deferred tax. Well, don't worry, you'll be fine.
It's not easy.
Okay, let's take the question 3. Okay, Kofi or
The
Kofi.
reader.
What is the name?
Yeah, Linus,
Yes, senior.
please, the question you just moved away from,
Yeah.
the taxation liability having a debit balance.
Okay.
I want to know why it's under provision.
You want to know why it is under provision?
Yes.
Okay. 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 Thank you. Okay. If it's having a debit balance, it means that the balance brought down will be at where? The balance brought down will be at the debit side. That is the meaning of debit balance. Are you okay? Okay. So we are estimating for 20,000. That is the 20,000 that we are going to pay GRA, isn't it? So this is a liability
Yes.
to us. So it will be at the debit side. But at the end of the day, GRA has given us 25,000 to pay, and we pay the 25,000. So if you pay, it means that cash is going to reduce, and the current tax also is going to reduce, which is a liability. So we debit the current tax account and credit our cash or bank, isn't it?
Yes.
Okay. But we are having
Yes.
20,000 as the liability that we are estimating. Now they are giving us 25,000, isn't it?
Yes.
Yeah.
25,000 against 20,000, what would the balance be?
We'll add it to the debit side.
The balance will be at the credit side to close to make 25, isn't it? So we add 5,000 to the 20,000 and make it what?
5,000.
Make it 25,000, isn't it?
Yes.
Okay.
In the previous year, this balance carried down will become a balance brought down over here. That is the meaning of the debit balance that they're talking about.
All right.
Are you okay now?
Thank you. Yes.
Okay, so if they say debit balance, it means that the balance brought down is on the debit side of the current tax account.
Okay. Thank you.
All right. Okay. Okay, my reader, let's take the question 3.
Question 3. Simple has estimated its income tax liability for the year ended 31st December 20x8 at $180,000. In the previous year, the income tax liability had been estimated as $150,000.
Okay.
Required. Calculate the tax expense that would be shown in the statement of profit and loss for the year ended 31st December 20x8 if the amount that was actually agreed and settled with the tax authorities in respect of 20x7 was A, $165,000, B, $140,000.
Okay. So let's take that one. Let's take that one by one. So our current year estimate is what? Current estimate is what? On the question, what is the current
150,000.
estimate? The current estimate is how much? 180. Okay. What was the previous year estimate?
150.
150,000, isn't it?
Yes.
Okay. So the question is now saying that you should calculate the tax to be paid if the actual tax agreed and paid was 165. That is A, isn't it? Okay. So it means that the actual tax paid was 165. This amount was paid This amount paid was relating to the previous year estimate, isn't it? Okay, so let's show our A, which is let's show the current tax schedule. Current tax schedule. So the current tax schedule, let me put the amount here. So what is the current year estimate? What is the current year estimate? It's 180,000, isn't it?
Yes.
Yes.
Okay. So our previous estimate was how much?
150.
150. So we
150,000.
subtracted 150 from the profit. But how much should you have subtracted before?
165.
165, isn't it?
165.
So it means that we were not able to subtract how much?
About
Under.
15,000.
15.
15,000.
We are not able to subtract the 15,000. So we cannot go back to go and subtract. So we just add it to the current year estimate, which is an expense. So we have under what? Provision.
Provision.
Under provision, yes.
Under provision of 15,000. So what will be the total
15,000.
current tax that will be shown in the
195.
195. The 180 is the one that we are going to subtract from this year. But 15,000 was not subtracted from the last year. So just come and add it to know the total amount that you are going to subtract.
Please, this is
Okay.
question what? Which question is this,
Question
please?
3. All right. So they are saying that we should assume that our actual tax paid and agreed on is 140. Okay. So B. We have
Question 3.
our current tax schedule. Our current tax schedule. Okay. So we start with the current year estimate. Current year estimate. Current year estimate. Current year estimate is 180, isn't it? But how much did we pay? 140.
140, yes.
But how much did we subtract? Previous estimate was what?
150.
Previous estimate was what? 150.
It was 150. 150, yes.
So we
150.
subtracted 150 instead of what?
Yes.
140. We
140.
140.
We subtracted 10,000 in excess. So this is an income. Net it against your current year was estimate 10,000. So we are going to have 170,000 as
Good evening. Sorry,
this thing.
I'm fine, please.
All right. So on this note, I can say that we are done with current tax, isn't it? Yeah. We are done.
Yeah.
Under provision or over provision is adjust against the current year estimate. All right. Someone can also decide to, yeah.
Please, this last question, I don't understand.
You don't understand?
This last question is just finished.
The last question that we solved. Are you sleeping?
I'm not sleeping.
All right. So simple. Okay, it's because of the name, because they are thinking that the work is simple, but it's not actually simple. Okay. Simple has estimated its income tax liability for the year ended 31 December 2008 at 180,000. So we assume that the current year is the 2S8, which is the current year estimate is what? 180,000, isn't it? In the previous year, the income tax liability had been estimated as what? 150. The previous year is which year? JM, the previous year is which year?
20x7.
Okay, 20x7. Okay. Calculate the tax expense that will be shown in the statement of profit or loss for the year ended 31 December 2008. If the amount that was actually agreed and settled with the tax authority in respect of 2x7 was what? 165 and 140. So they are saying that based on your estimate, which is 150, these are the amount that you have paid in respect of them. So if there was no under provision or over provision, how much should have been the tax that you are going to subtract from the current year profit? If there is no issue of under or over, how much are we going to subtract from the current year's profit?
180.
If there was no over or under, how much are we going to subtract from the current year's profit as current tax?
140.
No.
180.
That would be what? Someone mentioned a figure.
180,000.
It will be 180. That is the estimate that we are making this year. So if there is no under or over, we should have just go ahead and subtract what?
The current one.
Are you okay?
Yes.
But right now we make an estimate of what? 150. But we have now paid what? 165. It means that we should have made an estimate in the previous year, which should have been 165. So we should have subtracted 165 from our profit, but we subtracted only 150. But this year, we're supposed to subtract 180. That is what we're supposed to subtract. But we should have subtracted 15,000 from the last year's own, but we didn't do that. So what we do is that just add it to the figure that you are going to subtract for this year. Then you have your total figure to be subtracted from the profits. JM, am I making sense or?
Yeah, then it means that the A.
15,000
Yes.
plus 180,000.
It means that the A there was over.
There was under provision
15.
for the A.
Under of 15.
Yeah,
Or-
50,000. Yeah,
So we should add the 15 to the 140.
to the 180.
Please, then what happened to the B?
What happens to what?
The 140.
The one.
No, it's another question on
These
it.
are assumed figures. The A we do with the A first, 165. Then we assume that the actual amount paid is 140.
Okay.
So the first one we assume that we are
Thank
paying
you.
165 in respect of the 150. And the question is also saying that assume that okay, the actual amount that you paid was 140. So A is different, B is also different.
Thank you.
You're okay now?
So, Linus, as I was saying, so in
Yes,
the
I'm okay.
actual year now, it is the 180 plus the 15 that is outstanding.
Yes.
Okay, thank you.
Are you okay?
So
Yeah.
Linus,
Yes.
so it's like 180 is what you have declared to
What we are
pay.
expecting to deduct from the
To
current
pay.
year profit.
Yes.
Okay.
And then the difference is what you were supposed to pay and you didn't pay. So you come and add it to what you are going to pay this year.
What you should have subtracted, but you didn't subtract.
Fine.
Okay. So at the end of the day, you see that you are going to subtract all of them at the end of the day. So just put all of them together and go and subtract.
Okay.
So someone can also do this like this. The person will come and subtract 180, which is for the current year now from the profits. The person will say, oh, let me subtract 15,000 that is relating to the previous year.
It's the same thing. Okay.
So at the end of the day, you are subtracting 195 at it. So that is why we are saying that since they are all relating to tax, put all of them together as an expense and subtract.
Okay.
Are you okay?
Thank you. Yes, I'm okay.
You see, some of you are making my name as a common now. My name is a Papa.
Very soon it will become common.
That is what people you are doing. Let's look at. So we are okay with the current tax.
We a household name.
We are okay
Thank
with
you.
the current tax.
Our name cannot be household name. Linus is special name.
Yes, tell them. Linus, I was telling that if you go
Linus, your name that is on an ointment to look at the way you are happy about it.
if you
Linus
count
ointment, or you don't know.
no, out of the 30 million population, the people that are called Linus, they are not more than 100.
Hey,
Yeah, we are the second pope. We are in the Catholic Church. We are the second pope. Don't mind them.
Names like Rebecca is a very common, very common now.
Common.
Really, very common.
Linus. Ask whether their class, how many Linus there are throughout there. When they were going to
Another
school, how
common.
many
That's
Linus?
another common.
What about Dela?
The law is the law is
Very, very common.
No, my actual name is Dela Venunia. God favored me. The people, they can't pronounce the actual name, so they have been calling me Dela.
Your actual name is what? Dela what?
Dela Venunia.
Oh, okay.
So let's move on to are we okay with the current tax?
Yes.
Okay.
Yes, please. We are.
Let's move on to what we call deferred tax.
The problem is when they put it together, then
What
I
about the
become
B? Are we not calculating the B?
We have done a B already. Oh, we didn't see.
Okay. All right.
The B,
Then
we
it's
have
okay.
done the over provision and we have 170.
It's okay. It's okay.
Also, let's come to what we call deferred tax. Okay.
So the one we just did is under provision and of what? Over provision.
They are all relating, under and over are all relating to the current tax. So the current tax is basically about under and over provision. How do we treat it? That is the only thing.
And they are all under income tax, right?
Yes, they are all under income tax. The income tax is two: deferred tax and income tax. All right.
Okay.
Before we move on, I want to make a point. If you're an accountant, don't write a CV that you are going to pay for deferred tax. Basically, nothing is deferred.
That you are going to do what?
That you are going to pay for deferred tax. You are writing a CV, a PV that you are going to pay for deferred tax. No.
Okay.
Nothing is actually deferred, but we are just making a provision for a tax.
Lana, please, can I ask you something?
Yes.
Please, what is tax credit?
What is a tax credit?
Yes.
Okay, tax credit can be a situation where maybe you pay more tax than you should pay. The people can give you what we call a tax credit. Also, it can be a situation where you are overestimating your tax. That is also, they are going to refund you a tax. And if you are making a loss, it is allowed for some entities in the priority sector that they can carry over their losses for 5 years. So if you are making a loss, it means that GRA is owing you. You are not going to be paying tax, but rather they will be paying to you, isn't it? So you can calculate the tax that you are going to pay to you, and we say that is a tax credit. All right.
If you are making a loss, they'll rather pay you.
And you are here to do what we call advanced tax. Sorry. They do that for some companies. You see some startup companies that they require enough, like much capital to start. Like this one, hospitality companies like this. You see, before people get to know that we have a hotel and those things here to be, at the end of the day, you have already put the structures there and people are not coming. You have incurred the cost already. And you are going to have employees that you are going to be paying them. So you can be making a loss. And the law says that because the tax law, they want to encourage people to go into entrepreneurship, they allow certain entities, we call them priority sectors, where they are allowed to carry the losses over 5 years or something.
Yes.
And some of them are allowed to carry it over 3 years or something. So they are going to be paying, instead of you paying them, you can't pay tax on a loss, isn't it? So they will allow you to carry over those losses over years and deduct it for your profits. So you can be making a provision for it, which you can literally call a tax credit. So if you are making a loss, they can grant you a tax credit. They are going to pay you a tax, an amount now, but mostly they don't give it to you. Even if you are going to file for pay, that you pay more, they will not give it to you. They will say you should subtract it from the previous tax that you are going to pay. So if you pay more, the excess can be called a tax credit. Are you okay?
And you take it out from the next year's this thing.
Yes. So, Kathy, are you okay?
Yes, please. Thank you.
All right. Thank you too. So let's look at deferred tax. You see, actually nothing is deferred. Nothing is deferred. And it's not a liability that you are going to pay at the end of the day. We are doing this thing because of this. Because of this, we are doing a deferred tax because of these two things. The first one is you have to understand what we call taxable profits and also what we call accounting profits. Okay. Taxable profits and accounting profits. So taxable profits against accounting profits. Kathy, what is accounting profits? Rima, are you there? What is taxable profits?
The accounting profits It's the profit that the accountant declares
Okay.
for the accounting year or for the period. And then the taxable profit is what the tax authorities will declare to you when you submit your accounts.
Okay.
They will audit it and then they will tell you this is what you are supposed to pay.
Okay. Okay. That is nice. 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 Okay. All right.
Because they don't allow certain things. So what you deducted, sometimes they will add it back. So they will get to you the profit that your company is making. And it can be different from what you have submitted.
Okay. Okay. Do you have any point to before I call another person? Are you done?
Me, I'm done. No?
Okay. But you are not called Daniela. You are done, but you are not called Daniela. That is very nice. All right. Esther Yakubu.
Yes.
Yes. Taxable profit and accounting profits. What is the difference?
The accounting profit is the profit declared by the company after the preparation of the financial statement.
Okay.
And for the taxable profit, I'll say is the profit also declared by the tax authorities after adjustment of the capital allowances.
Okay. That's nice. That's a nice attempt. Philip, you are here. Philip, are you on top of issues? Okay. Last person should come. JM, come, let's move on.
Okay, taxable profit is a profit tax is charged on, and the accounting profit is a profit that the person earned after deducting all expenses. But the tax does not allow depreciation, so they will add depreciation back to the profit to tax you on it.
Okay, that is nice attempt. The guys will be thinking why I'm not calling them. Law of magnetism. I can't call you. All right.
I zip my mouth.
It is well.
Okay. So, if you talk about taxable profit, is the profit based on which the tax authority is going to calculate their tax that the entity is going to pay. So the profit based on which tax is going to be calculated in the books of the tax authority is what we call the taxable profit. So the profit on which the tax authority is going to base their tax calculation on and give it to you that this is the amount that you are going to pay is the taxable profit. But accounting profit is the profit in the published financial statement of the entity. So the profit being declared as a profit for the year is the accounting profit, which is always declared by the accountant by taking all the expenses against all the income. But after adjusting the financial statement of the entity, basically the statement of profit or loss for the entity, and the tax authority has allowed and disallowed some things, the amount that they are going to, okay, we can call it chargeable income. So the amount that they are going to calculate their tax on is the taxable profits. But what normally happens, this is what normally happens. Okay. This is what normally happens. Okay. Assuming that the entity has plants, which will which has a value of 4,000, a remaining useful life of 2 years. A remaining useful life of 2 years. A remaining useful life of 2 years. Okay. Okay. All right. You see, plants, what the tax authority that they do is that they normally, you see, what is the essence of you buying non-current assets when they cannot be allowed, or the tax authority cannot give you allowance on them? No, you can't buy because these assets, you are using them purposely for your business. So the tax authority cannot do anything on it in respect of tax. People will not be encouraged to go and invest in non-current assets. So the tax authority or the tax law is being fair to people that, okay, since you're using this asset for your business, let's grant you some allowance on them, which will reduce your tax liability. So the accountants, let's assume that all things being equal, the profit for these two items are the same. 20,000, and accounting profit is also 20,000, all things being equal. That is profit before depreciation. Okay, so if we are doing this, what will be the depreciation for the accounting profit for the first year? What will be the depreciation? What will be the depreciation for the accounting profit?
That will be 2,000 or?
That will be 2,000, isn't it? Okay.
Yes.
That is the first year, it will be 2,000.
At what rate?
We are using 2 years.
2 years, so divided by 2.
Okay. Let's assume that the tax authority is giving you capital allowance 3,000 in the first year. So it means that the taxable profit from the books of the tax authority will be how much?
3,000.
Will be 17,000, isn't it? This will be 17,000. But in the books of this one, they are going to be having 18,000, isn't it? Okay. Let's assume that the tax rate is 25%. What will be the tax for the year? The tax rate is 25%. Under the taxable profit, what will be the tax? And under accounting profit, what will be the tax?
Accounting profit will be 4,500.
4,500, isn't it?
Yes, 4,500.
And this will be
4,000.
4,250. 4,250. What's the difference?
The difference is 250.
250. What is causing the difference? Okay, let's leave what is causing the difference and go to different year. Let's assume that this is the first year. Accounting profit is still the same for the two. 20,000, 20,000. So let's come here. What will be the capital allowance in respect of the assets in the second year? How much will the tax authority be given? The asset is 4,000. They have given a capital allowance of 3,000, isn't it?
So, yes.
They will now give what?
So 1,000 is left. 1,000.
1,000. They will now give 1,000. And the accounting profit will still be charging a depreciation of what?
2,000.
2,000. Okay.
Linus, at least I'm not getting the 1,000.
You are not getting
the 1,000.
You are not getting what?
The 1,000
is the 4,000 minus 3,000.
Oh, the asset, the value of the asset is 4,000. They have given a capital allowance of 3,000 in the first year. So the second year will be the remaining balance. Are you okay?
Okay.
Okay. So this will be 18,000 now. Let's look at the tax. The tax that you are going to pay, 25 and the 2.
$4,750.
4,750 against what?
4,500.
Okay. So how much are you paying in excess?
2,550.
250, isn't it? Okay. So now you are paying 250 in excess, but in this particular year, how much are you paying? You are paying 4,250, isn't it? But this year you are not paying 4,750. The actual tax is the tax for the taxable profit. That is the tax that you are going to pay. You are going to pay 4,250, but in this year you are paying 4,750. You are paying 250 in excess. You are paying 250 less. Okay.
Yes.
Do you know why these 250 differences are there? Okay. The assumption is that you see the tax authority has given you 1,000 in excess for the capital allowance, isn't it?
Yes.
Okay. That means in the future, that 1,000 that you are going to be subtracting from profit as 2,000. The tax authority is going to give you only 1,000 because the 2,000 you are going to have will not be available for deduction for tax. So what the tax authority is now doing is that they are giving you 1,000 excess, which you are going to enjoy today, but you are going to pay for it in the what?
Tomorrow.
In the future. So what we normally do is that since that particular transaction happens today, and we know that we are going to pay that particular thing in the future, let's make provision for that particular increment, that particular losses that we are going to suffer as a result of the 1,000 that we have enjoyed in excess. So what we normally do is that we find the difference between the capital allowance and the depreciation. What is the difference?
1,000.
The difference is 1,000. So we apply the tax rate on it. That will be how much?
That will be 250.
250. So what will happen? We subtract the 250 from this figure, the 4,500, to make it now 42 what?
50.
So what we do is that we just want to eliminate that particular effect that is caused by the difference. We want to eliminate it and make the figure the same as what the tax authority is giving us. That is the provision for the deferred tax. So if
Linus, please take it again.
Okay. Is it?
Please take the explanation again.
Okay. I should take it to where? All right.
It's lying down, so we take it again.
Okay. So, Patty, you're okay with the tax that you're going to pay under the taxable profit and this one, isn't it? Are you okay with that side?
Yes, please.
Okay. So, what is causing this difference? It is 1,000. It is 1,000 Ghana cedis that the tax authority is giving in essence, isn't it? It is 1,000 because we are charging a depreciation of 2,000. They are not giving
because they are supposed to give you 2,000 and they gave you 3,000.
So it means that they are giving you tax. They are giving you 1,000 in excess, isn't it?
Okay, so
it means that in the future, this 1,000 will not be given on the same asset again. You have enjoyed it already.
Okay.
You have enjoyed it already. So in the future, it will not be there. So just assume that the assumption is just assume that you haven't enjoyed this particular 1,000 now. That is why you have to make the provision to eliminate the tax difference that 1,000 is causing.
Oh, okay.
And take it to the future. Are you okay? Okay.
Okay.
So what will happen? Look at this. What will happen? Look at this.
Okay.
So we will now make provision for that 1,000, which we are enjoying today, but which we should have enjoyed in the future. Take it to the future. Don't enjoy it today. Take it to the future. That is why we are subtracting it from the 4,500. So we make provision on this one. The tax that we are going to pay will be 25% on this. In the future that we are going to pay. This will not be for now. Let's take it to the future. So let's eliminate it. So we find this and subtract it from the 4,500. We get 4,250. Let's come here. What is happening here?
They've given you less.
They have given you less, isn't it?
Yes.
So what will happen? It means that you are charging more. So this will be a tax credit. This will be a tax credit, isn't it?
Yes.
You should have subtracted 1,000, but you subtracted 2,000. It means that you are subtracting more. Are you okay?
Mm-hmm.
So if you make provision for this one, it will still be 250. But this will not be a reduction. This will be what? Addition.
Addition.
So if you add it, you still get your 77.50. Then you now have your tax that you are going to pay. That is the idea about a deferred tax. It's nothing more. You're supposed not to enjoy the tax, the what they are giving to you. You're supposed not to enjoy it today. It will be enjoyed in the future. Remove it from today and take it to the future. That is all. That is the deferred tax. That is basically the idea of the deferred tax. All right. So the deferred tax is the estimate of the future tax consequences that we are enjoying today, but will be incurred in the future. That is the deferred tax. Nothing more, nothing less. All right. But for you to understand the deferred tax, you need to understand two things. What are the things that is causing this difference? What are the things that is causing these differences between the accounting profits and then the taxable profits? Okay. You see that in the financial statement, the company can charge amortization on what? Goodwill, isn't it?
Mm-hmm.
Would the tax authority allow amortization?
No.
No. So items that are not allowed for tax purposes, we don't charge any, we don't provide for deferred tax on them because the tax authority is not going to recognize it. So we are not going to suffer any loss. We just suffer the loss. That is the end. So they disallow it, we pay for it today, and that is the end. So if you want to understand deferred tax, you have to understand two issues. We have what we call temporal differences and also permanent what? Differences. So we only make provision for differences that are temporal. Example is the depreciation. Depreciation is taken into consideration by the tax authority. They are going to give you capital what? Allowance. Another one is research and development expenditure. For companies, as soon as you incur the research and the development expenditure, the tax authority will give you capital allowance on the whole amount. On the whole amount. But what the company will do is that the company will now capitalize this research and development expenditure and be amortizing it over years. So Charlie, for me not to confuse people, let's stop. Take this understanding of the deferred tax to the house.
Oh, why continue?
No, it's 7:35. Are you okay? I have to.
But we're coming back, right?
Yes, I'll come back for corporate reporting.
Yeah,
So
but Linus, we need to know the things that causes that.
yeah, we take it again next week. But you take
Because
you understand this, the deferred tax issue here, you understand, isn't it? Take it to the house like that.
no, I'll not take it to the house now because there was a deferred tax and they brought so many things in that we didn't know. So we were confused. That is why
No.
like what you are saying.
Don't worry.
We were what
I'll-
causes the temporary difference?
I will solve that question
We
for you.
want to
don't worry.
know. And they bought so many things, inventory and decontamination and all that, and
Don't
we
worry.
didn't know.
Don't
So
worry.
please.
I'll do that for you. I'll look at that question.
Now,
I'll answer that question for you.
ICG,
It's okay. Kathy.
DA people, they are not doing things like they used
Someone
to.
is saying that, hey, this lady. Someone is saying that, hey, this lady.
Oh yeah, I know what I'm talking about, my dear. I know. It is not easy in the exams room. So he needs to teach us everything. If
Don't
he
worry.
limits himself to certain things that we know already, and you go, they bring new things that you don't know. So he needs to teach us. So allow me, why? Me
Don't
na
worry.
minim dia ma face.